Nowadays, the business world has kind of become like Instagram. A trend enters the market and all the companies begin following it. That's what happened with NFTs and the metaverse. And another trend that is quickly taking over India is quick commerce and 10-minute deliveries. However, this trend has already begun causing problems for one of the first companies that adopted it, Blinkit. Welcome back to Revolution Read On, a daily podcast where we break down one story from the world of business and finance. Click on the subscribe button to never miss an update from us. Here's your story for today. The quick commerce trend began last year after a new startup, Zepto, started promising 10-minute deliveries. Around the same time, Swiggy also announced that it would start delivering groceries in 15 to 30 minutes. Blinkit, which was then Grofers, saw that the quick commerce space was gaining momentum, so it jumped in on the trend. It became so invested in this 10-minute delivery model that it changed its name as well. Grofers became Blinkit, which delivers in the blink of an eye. This was all the FOMO, that's fear of missing out, that other companies needed. So soon, Dunzo, Swiggy, Geomart, and others all entered this space. Tata's Big Basket and Flipkart are also planning to dive into quick commerce. But these quick deliveries come at a massive cost. It's not possible to deliver groceries straight from the grocery stores to the customers in 10 minutes, which is why Domino's ended its 30-minute delivery promise. Remember those ads? So these quick commerce companies set up dark stores, which are warehouses stocked with groceries to fulfill their promise. Now, this is an additional expenditure that they are taking on at no extra profit. In fact, companies are burning more cash than they would have if they stuck to normal deliveries. Meanwhile, they can't alienate customers by charging them extra for fast deliveries. Instead, what they're trying to do right now is change customer behavior. Once they get used to fast deliveries, these companies may add delivery charges or subscription fees. But the question is, will they survive the cash burn phase to reach that point? Blinkit has realized it may not be able to do so. Even investors are currently unwilling to fund its spending spree. And the rebranding means now it has to make 10-minute deliveries by hook or by crook. So it had to shut down operations in some cities where it couldn't deliver in 10 minutes. Plus, despite spending over 600 crore rupees since November to expand its business, it has only seen a 4% growth month on month since January. So its cash burn is still too big. So much so that it has now had to shut down around 50 dark stores and lay off 5% of its workforce. Now, since investors won't give it any more money, the company sought debt from companies like Zomato. But this debt offer has now turned into a merger option. Zomato has already invested 120 million US dollars in the company last year. So it thought, why not take this relationship further? The merger will be a share swap deal, meaning that the two companies will give each other stake instead of cash. However, the merger will value Blinkit at 700 to 800 million US dollars, which is lower than its current billion-dollar valuation. But why is Zomato buying a sinking company? Firstly, it puts it on equal footing with its main rival, Swiggy. They both will now have a quick commerce arm. In fact, Zomato may be at an advantage because Blinkit averages 190,000 orders daily, whereas Swiggy Instamart was averaging 1,000 orders per day until last December. Secondly, Zomato's business is also not profitable as of now. So, it is taking a page from Alibaba and Tencent and trying to make money by investing in up and coming startups. It has so far acquired an 8% stake in ShipRocket, which is Bigfoot Retail Solutions Private Limited, for 75 million US dollars. 16% stake in MagicPin, that is Samas Technologies Private Limited, for 50 million US dollars, and also invested 50 million US dollars in CureFit. This investment strategy also allows Zomato to leverage these companies' tech and not have to develop its own. Blinkit, on the other hand, got a lifeline. But this makes us wonder what will happen to other quick commerce startups like Dunzo and Zepto? Will they manage to be successful? Or will they also go the Blinkit way? Only time will tell. Thanks for listening in. Make sure to follow this podcast if you aren't already. We'll be back tomorrow.